Welcome to the video. First, we will explore how bank, emergency cash, or small lines of credit work, and whether they help or hurt your credit score. Next, we'll unpack eligibility, reporting to credit bureaus, potential benefits, the hidden costs, and smart ways to use or avoid these products. Finally, we'll end with a quick quiz and practical takeaways you can use today. To set the stage, here is the roadmap. First, we define what these small lines of credit are. Next, we clarify the difference between initial eligibility and how activity is reported to credit bureaus. Then, we break down how your score can improve with responsible use or fall due to late payments and high utilization. After that, we discuss what happens if you never use the line, reveal hidden costs, consider safer alternatives, and outline responsible usage strategies. Finally, we test your knowledge with a brief quiz and close with key takeaways. To begin, small lines of credit marketed as emergency cash can feel like a lifeline. However, their structure and fees can make them expensive, and their reporting can either build or damage your credit profile. Understanding the mechanics helps you decide when, how, or whether to use them. First, let's define the product. A small line of credit, often branded as standby cash or something similar, is a revolving credit line linked to your checking account. Banks may grant access based on your relationship history and deposit patterns, rather than a hard credit check up front. You can draw funds when needed and repay them, restoring available credit as you pay down the balance. However, eligibility can fluctuate over time if you fail to meet internal criteria such as minimum deposits. Next, let's visualize the difference between eligibility and reporting. Initially, the bank looks at your relationship and deposit history, often without a hard credit inquiry. If approved, the account opens. Reporting to credit bureaus typically starts when you actually use the funds. At that point, your utilization, balance, and payment history can impact your credit score. If you never use the line, the impact is usually minimal, though the bank may restrict or remove access if internal requirements are not met. Moving on. Your credit score reacts most strongly to payment history and credit utilization. Paying on time is crucial. Even one late payment can do damage. Carrying a high balance relative to your limit raises utilization and can lower your score. Over time, maintaining the account may modestly help the average age of accounts. Having another revolving line can also contribute to credit mix. However, opening any new credit line can create short-term score fluctuations as your profile adjusts. Now, this pie chart illustrates typical credit score factor weights. Payment history at roughly 35%, and amounts owed or utilization around 30%. Length of credit history contributes about 15%, while new credit and credit mix each account for around 10%. The takeaway is that paying on time and keeping utilization low are the most influential actions you can take with a small line of credit. Meanwhile, if your line remains unused, the impact on your credit is typically minimal. Some banks may still report the account's existence, while others primarily report when funds are drawn. Eligibility to access funds can change if you no longer meet internal requirements like deposit minimums, so you could see your available balance reduced to zero or the line deactivated. Next, let's address costs. Many of these lines of credit are expensive. APRs can be in the high double digits depending on the bank and your profiles. Some charge a cash advance or draw fee, often around 5% of the amount drawn. Interest may accrue daily and compound, and there may be late fees depending on the terms. A small example. Drawing $500 for 3 months at a high APR, plus a 5% fee, can produce a noticeable total cost. These products should generally be a last resort, and if used, repaying quickly is essential. Now let's compare. High-cost lines of credit offer speed but carry significant APRs and draw fees, which can make debts grow quickly. On the other hand, credit unions may offer lower-rate personal loans. 0% introductory APR credit cards can work if you qualify and have a payoff plan before the promotional period ends. Employer or hardship programs can provide no or low-cost short-term relief. Negotiating payment plans with service providers can also help. Ultimately, building an emergency fund remains the most sustainable solution. Moving forward, here are practical steps. Keep your utilization as low as possible, ideally under 10 to 15%. Set up autopay to avoid missed payments. Repay as quickly as possible to minimize interest and fees. Monitor statements closely for fee changes and accruing interest. Track your credit reports monthly to confirm accurate reporting. Finally, have an exit strategy to refinance or replace this debt with a lower cost option, and then rebuild an emergency fund. Quick knowledge check. Which factor has the biggest impact on your credit score when using a small line of credits? Options are A, credit mix, B, payment history, C, new credit inquiries, or D, number of bank accounts. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, payment history. On-time payments strengthen your score, while late payments can cause substantial negative impact. Second question. If your line of credit remains unused, what is the typical impact on your score? Options are A, large positive boost, B, large negative hit, C, generally minimal impact, or D, immediate closure of all other accounts. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C, generally minimal impact. If the account remains unused, the effect on your score is typically small, although the bank may change your access eligibility based on internal requirements. Next, this timeline shows the journey from pre-approval based on banking relationship and deposits to activation. Once you draw funds, your activity is typically reported monthly to credit bureaus, including utilization, balance, and payment status. With on-time repayment, the account ages and may contribute modestly to your profile, but remember that access can change if you stop meeting internal criteria. Now let's consolidate best practices. Use reminders and autopay to prioritize on-time payments. Keep balances low, ideally under 10 to 15% utilization. Carefully read the terms to understand fees, APR, and how interest accrues. Have a payoff plan before drawing any funds, and consider lower-cost alternatives first. After you pay off the balance, focus on rebuilding your emergency fund to reduce future reliance on high-cost credit. Before we wrap up, a quick but important reminder. This video is educational and does not constitute financial advice. Product terms, fees, and reporting policies vary by bank and by individual profile. Always read your specific agreement and consult a qualified professional if you need guidance. Using high-cost credit carries risk, so evaluate alternatives carefully. Next, here are the essential points. Eligibility often depends on your banking relationship rather than an initial hard inquiry. Reporting usually begins when you draw on the line, and the largest factors are payment history and utilization. Unused lines typically have minimal impact, although access can change. Costs are often steep, so use sparingly and repay quickly. Lower-cost alternatives exist, and building an emergency fund is a key long-term strategy. Finally, let's wrap up with action steps. Treat a small line of credit as a last resort and repay as rapidly as possible. Automate payments, keep utilization low, and monitor your credit reports for accuracy. Shop for lower-cost options and negotiate payment plans where feasible. These steps will protect your credit profile and your wallet. Thanks for watching. To close, please like the video, share it with someone who might benefit, and subscribe for more practical money guidance. Drop your questions, experiences, and tips in the comments so we can learn together.